Good morning, ladies and gentlemen. It's a real pleasure to be here this morning speaking to you at such a distinguished event. You can see from the tie and jacket that I come from London, and it's a real pleasure to be here. Even more so because even though I was an investor in Latin America and global emerging markets for over a decade, I could never find a reason or an excuse to come to Cartagena and see the beautiful old city and the beaches. So I'm very pleased to be here. I spend a lot of my time now speaking to our clients, to large pension funds, about the outlook for emerging market equities. I also discuss the role that emerging market equities can play in their asset allocation. And that is the primary topic of my discussion today. I will talk about how pension funds globally, how investors globally have changed their approach to asset allocation and how they use emerging markets. And in particular, I'll discuss how even though there is a search for growth assets, many investors are still underweight emerging market equities. And that is good news for you because it means continuing flows into markets like the Bolsa here. I'll then secondly talk about how pension funds structure their exposure to emerging markets, both global emerging markets, regional and single country, as well as specialist funds like small cap. And again, explain how Colombia fits into that and what the implications for the Bolsa is to make the Bolsa more relevant for global investors. And finally, although the emerging market story is very strong, they have underperformed developed markets in the last 18 months. So the questions, now many of you here, that will be a surprise because the Bolsa here has performed so strongly, but many of the main emerging markets have underperformed. So I will explain why, because we get asked a lot, is this the end of the emerging market story? And we think categorically no. And I'll talk a bit about countries, currencies, and valuations. But first, let me talk about how asset allocation techniques have evolved over the last 20, 30 years. And if you look on the left-hand side of your screens, you'll see the classic balanced model, fixed, 60-40 equity debt. And during the 2000s, this evolved as investors were looking for uncorrelated sources of performance. So they started adding alternative investments. This was the so-called Yale model after the Yale University Endowment Fund. But this all changed after the volatility of 2008. And instead, there were two major changes. Instead of thinking about the assets, what do you own and what return will they give me, investors started thinking about, here are my liabilities. This is what I need to pay. How will I cover those liabilities? And they started thinking in terms of growth assets, income assets. The second thing is that they wanted, instead of sitting down every 5 years to discuss a strategic allocation that was fixed, they decided to move towards more tactical or short-term allocations in order to exploit volatility. And the other trend was that we saw this increased move to separation of alpha and beta, so the rise of passive strategies. Now, emerging market equities neatly fit into that growth asset bucket, if you will. So that has been a further driving force for the growth of the asset class. Now, where do regional Latin American pension funds sit in this? Well, I sometimes think that the Brazilians are not even in the 1990s. Maybe they're in the 1970s still, because with very high interest rates, they have a balanced model that is even more extreme, 80% debt, 20% equities. But that is changing now as interest rates come down, and you've been through that process here. AFPs in Colombia and Chile and Peru have embraced more of these other techniques. So we're seeing more use of alternatives, infrastructure, and the use of active and passive, and they already have the skills to asset allocate. So they have adopted a lot of these techniques, but not all of them. And that is a good thing, because not all innovations add value. And if you look at this, is a survey from Create, which is an asset management consultancy that surveys the largest pension funds globally. And if you look at the bottom, in answer to the question, which innovations provided the most value or least value, you can see innovations like leverage, structured products, currency funds, portable alpha. So not all innovations are good, and in fact, when they mean they added least value, what they really mean is they lost most money for investors. Now, if you look at the top, in contrast, you can see that emerging markets, both debt and equity, were considered to deliver the most value. And this is really what's driving a structural shift away from home bias in equities towards internationalization and the increased use of emerging markets to deliver that growth in a low-growth world. Now, we think we're still at a very early stage in this process because urbanization and industrialization and consumption, the drivers of emerging markets, are still at an early stage in many markets, as is the development of the stock exchanges. If you look at this data from Goldman Sachs, you'll see that at the beginning of last decade, emerging markets were 1/3 of global GDP, but if we look at the standard index used by global investors, the MSCI index, you'll see that emerging market equities were just 13%. So they are underrepresented. And this is changing, and Goldman Sachs expect that by the end of 2030, emerging markets will be 2/3 of global GDP, and the index will be 30% emerging market equities. So this is a very long-term process, and we're not even halfway through there yet. And this makes total sense if you look at the chart, the map of the world. This comes from McKinsey, the consultants, and it shows the top 600 cities globally. They produce 2/3 of global growth. That number won't change between now and 2030, but the cities will change dramatically as you see urbanization in emerging markets. What I think is interesting is the second-tier cities in emerging markets in 2030 will produce more economic output, GDP, than all of the megacities of the developed world and the emerging markets. So New York, London, Mexico, Sao Paulo. So this really is a very long-term shift. Deciding what your neutral weighting to emerging markets is very important for pension funds, because they don't want to be chasing a rising index and always be behind it and underperforming, particularly underperforming their peers. So we don't just look top down, but we look bottom up as well, because we're stock pickers. And on the left-hand side, we show you some of the key brands within emerging market, within Latin America. And it's to remind us that what drives performance is about corporate profitability. And we also include some of the world's most innovative. These are the brands that are in the top 100 innovative brands globally. And many of you will have an HTC phone or a Samsung in your pocket. And this reinforces the idea that profits in emerging markets are going to be growing faster than in developed markets. And if we look at the percentage of profits from companies based in emerging markets, it's currently 15%. And we expect that number to rise, just as on the previous slide you saw the Goldman Sachs estimates. But not all investors have understood this trend, and many of them are behind the curve. This data is all publicly available on websites, and it shows the asset allocation of the largest investors globally. And what you can see on the right-hand side is people like Abu Dhabi Investment Authority or Norges Bank, the two largest sovereign wealth funds in the world. And they have above 15% equity exposure to emerging markets. They are the most sophisticated investors. They understand the trends. If you look on the left, though, GPIF in Japan is the world's single largest pension fund. It's 1.3 trillion US dollars. They only started investing in emerging markets this year. If you look in the middle, you'll see US institutions. And this is a survey of 1.7 trillion in assets, and you can see year in, year out, there's been an increased move here. So what we're seeing is that the most sophisticated investors, the sovereign wealth funds and European pension funds and US endowments are ahead of the curve, but there's a lot of people who are still behind the curve. Now, where are the Colombian AFPs in this process? Well, 1/4 of their equity exposure is international, and 1/3 of that international exposure is in emerging markets. So you could say that they're on the right-hand side, the right side of this chart. But there's still very significant home bias with the AFPs, and that needs to change. And if you look at the Chilean AFPs, they have already made that move, reduced domestic in favor of foreign, and they have 70% allocated to emerging markets. I'm an equity investor, but it's not all about equities. It's about debt as well, in this search for growth assets. We show you here the flows into mutual funds globally. So it doesn't capture everything, but it's not bad. And you can see that emerging market equities really accelerated from 2004, 2005. And what we're seeing now is emerging market debt beginning to become a mainstream asset class. And this makes total sense, because in a world of extreme monetary policy of QE3, the US dollar weakens and spreads across the curve come down. So investors are looking for yield pickup for income, and they're going to high yield and emerging market debt. So this is an ongoing story. Now, it's not just in sovereign hard currency debt, but it is also in local currency debt and corporate debt. This year, there'll be $250 billion issued by corporates in emerging markets. But most of that will be in Asia. So the opportunity for Latin America is to get into the corporate debt market, because that is the next big growth asset, in our opinion. The other reason why emerging markets and emerging market debt are becoming so popular is because they perform very well together in different economic environments or regimes. And our analysts did a lot of work on trying to understand, given this move from fixed allocations to more tactical allocations, how different asset classes perform under different environments. So you can see on the left, we show a recession, stagnant economy, moderate economy, strong economy, stagflation. And the blue boxes with the red print is emerging market equities. So quite naturally, they underperform in a recession. Think about 2008. But in that environment, emerging market debt does reasonably well. But in most other environments, the combination of equity and debt adds value, adds performance to portfolios. So there's no such thing as an all-weather asset class, but emerging markets is as close as it gets. Now, a word of caution. The grey line here is the spreads on emerging market debt. And what you can see is that they have reflected improving fundamentals over the last 20 years. Far better fiscal and debt dynamics. And spreads are now quite tight. They have become a low-risk asset class. In contrast, the blue line is what we call the earnings yield, or it's the earnings spread of equities, and you can see it has gone up. Equities are considered to be an even riskier asset class than they were in the last decade, and I'll come back to that later because we think there's a valuation opportunity. So in most markets, equities look cheap to debt, and that is the same in emerging markets. Now, I've talked a lot about how we think and how pension plans are changing asset allocation, how they're moving to growth assets like emerging market equities and debt. But now let's think about how they gain exposure within the asset class, within emerging markets. And the first trend to understand is that liquidity has increased dramatically in emerging markets. This chart shows the number of stocks that trade at certain liquidity levels every day. So the top line shows you the number of stocks that trade more than $2 million a day. And it's gone from 500 a decade ago to close to 2,000 today. And you can see that at different levels of liquidity. So liquidity, in terms of the opportunity, the number of stocks, has increased 4 times in the last decade, the last 12 years. Now, Colombia has participated in that. Again, if we look in the standard MSCI index, there are 14 stocks in the index here, but 6 of them represent 3/4 of the market capitalization. So it's quite concentrated. Now, global investors, Colombia is a relevant asset class, a relevant destination for global investors. But for it to become more relevant, we need to see increased liquidity, increased number of stocks trading to really put it on the map for global investors. And let me give you an example. If you think of the major markets beyond the BRICS, let's call them the second tier, Chile and Turkey are definitely in that second level. They're fully on the radar screen of investors. Now, Turkey and Chile have the same market capitalization as the Bolsa here, but they have a far higher free float. Less of the index is controlled by founding shareholders or the government. And if you look at Turkey, because they also have a lot of retail investors, daily liquidity is over 10 times the liquidity in the Bolsa here. So Turkey is very much on the map. So what we need to see here to increase the relevance is new issuance, sell down of assets, and the introduction of more retail traders. Now, let me go through the 3 different levels of investors. We've got, first of all, global emerging market funds, which can invest anywhere. Secondly, we've got regional or single country strategies. And thirdly, we've got specialist strategies like small cap or so-called frontier markets, which now include Argentina and places like Nigeria. But let's start with GEM. What's important to understand if you're trying to attract capital from foreign pension funds into Colombia is that most assets are managed in global funds, global emerging market funds, not regional specialists. So they're the people you need to get to know. If you look at mutual funds, there are $480 billion in GEM, or global emerging market funds, and just $53 billion in Latin America and Latin single country funds. So GEM investors are very important. If we look at regional strategies, the trend among international investors we speak to is to want to have, if they're going to have regional investments, they want specialist managers who can deliver a lot of outperformance. And they feel that they should be based locally within the region. We agree. We're building up our operations in Latin America, particularly in places like Brazil. But the big issue for local fund managers is that after scandals like Madoff, due diligence is increasingly important. And therefore, local fund managers need to increase their compliance functions in order to attract foreign pension fund money, and local brokers need to improve their compliance function in order to trade with global portfolio managers. So that is a key trend. The other thing we see is that if I'm a pension fund and I want to invest in regional strategies or single country strategies funds, I need two skills. I need to be able to choose good managers who can outperform, but I also need to be able to asset allocate. I need to be able to say Latin America is going to outperform Asia. And what we find when we speak to global investors as emerging markets become more mainstream is that they just can't asset allocate within emerging markets. It's just beyond them. They can asset allocate between equities and debt, US and Europe. So what they're saying is we're no longer interested in regional strategies. We want to be going into global emerging markets. And if you look at fund flows year to date, there's been about $25 billion into GEM, global emerging market strategies, while regional and single countries are slightly positive. But this is a trend that worries us because we are specialist regional managers with people on the ground. But it again reinforces this idea that you need to be speaking to global emerging market investors. Finally, let's talk about some of the specialist strategies. And people are looking at ways to increase their exposure and complement mainstream emerging markets. And small cap, the smaller capitalization stocks, are increasingly popular ways of doing that. For a fund manager, for investors like that, we like small capitalization stocks because they tend to avoid global cyclical sectors like energy. Those are large cap stocks, and they tend to be very exposed to domestic demand sectors, consumption, retailers, and infrastructure development. And that's really the growth story within emerging markets and rising incomes. The second reason we like them is that they're very inefficient. If you have a good research team, you are able to add a lot of outperformance, whereas in large caps, it's very difficult to add value. You must find that the same thing in your research teams. So this shows you, we screened on Bloomberg, and we looked for all companies less than $3 billion in emerging markets, more than 200 million market cap though, so not micro cap, that trade more than $1 million a day. And there's about 3,000 of them. And we can see how many analysts cover them. And in blue, about 1/3 are very well covered, more than 10 analysts. But if you look on the right-hand side, about 1/3 have less than 2 analysts, and most of those are very old. There'll be coverage going back a couple of years ago. They're not relevant. And so this is an area where global investors with big research teams like ours and like the other major houses can add a lot of value. And it's important when you think about your research priorities that you think about small caps, because that is a place where brokerage and research units in Colombia can differentiate themselves, or in Latin America can differentiate themselves from the large bank-related brokerage houses. And when I look at Asia and Eastern Europe, what I see is that the most successful independent brokers all started off by having a niche in small cap. And so this is an area that you may want to look into. Now, talked about emerging markets as a whole. We've talked about the 3 different segments, GEM, regional, and specialist. Let me wrap up by talking about the outlook for emerging markets. And before I go into individual countries and currencies, let's address this issue of underperformance. And as I said, the Bolsa here has done very well. We'll talk about that, about valuations in a minute. But lots of global investors have said, is the story over? And we think no, because when we look at macro or economic fundamentals, think back to that emerging market debt slide. They've never been this good. When we think about valuations, they look very cheap to us, and I'll show you some data in a minute. So it must be about profitability. And when we produced this chart, it became very clear to us that costs in emerging markets have been outpacing revenues in the last 18 months. And the lines here, the grey line is the relative growth of emerging market companies' revenues relative to developed market companies. And as you would expect, they've been growing a lot faster. And historically, the blue line, earnings, has outpaced as well. But what's happened in the last 18 months is that costs have been rising in emerging markets. So let's think about that, and there may be examples of how this is happening in Colombia as well. We think there are structural factors, long-term factors, and cyclical short-term factors. The structural factors are that wages are rising because as emerging markets came out of the global financial crisis, they didn't have much slack in their labor markets. And so more of the profit is going to labor than capital now. And think about what's happening in China. The government there has said, we will rebalance the economy from investment to consumption. And when we speak to companies there, they tell us that means that they have to increase the wages of their employees on average by 15% per annum. Now that's going to hurt margins for a while. Now, as stock pickers, we can find businesses that will avoid that. So it doesn't worry us because as wages go up, consumption will rise. But there are other factors here, which is lagging productivity. And in Colombia, productivity has been quite flat for a while. So this is more of a concern. But the cyclical factor, which we don't worry about, is that we've had rising inflation in emerging markets generally. And you had the same phenomenon here in Colombia. In 2010 and 2011, inflation picked up. BANREP had to raise interest rates. Inflation is now rolling over. And this is happening not just here, China, India, Brazil, almost every market we can think of. And now they're beginning to cut interest rates. So the cyclical pass-through of inflation, which hit earnings growth, is now beginning to come out of profits. And so we would expect, particularly since the brokers and analysts have cut earnings dramatically for this year and next, we would expect earnings expectation to continue to rise into the rest of the year. So we remain upbeat. We do not think that, we think this was a cyclical phenomenon. Now let me talk about individual countries here, and I'm more than happy, we'll do a joint Q&A after both of the discussions to go into details here. But this is the way we think about countries. We want to buy cheap countries with an improving trend, with a catalyst in place. And countries on the right-hand side of this are cheap relative to other emerging markets on various valuation measures. But we want to have a catalyst. We want to see that they've already begun to outperform because AR is Argentina. It's cheap. There's no catalyst. It's not going to perform, we don't think. So what we want to do is we want to be looking at countries here, China, Russia, Brazil, that are cheap relatively and have begun to outperform. And we want to be cautious about markets in this box which are more expensive and have done very well. And because of the risk-on, risk-off of last year, there are two separate groups of countries. There is Mexico, Malaysia, Indonesia, Chile that have very relatively defensive stock market indices and a lot of domestic businesses. And they have become relatively expensive as people have paid to hide from global volatility. Whereas large markets like China, Russia, and Brazil that had big inflation problems, and now the question is, do they soft land or hard land, has caused valuations to fall in these markets. Now, we believe that there is a soft landing in China unfolding. We've been saying that for over a year now. It's been a very slow process, but we do see evidence that the economy is beginning to bottom out. We don't think the Chinese authorities will stimulate very dramatically because they created an inflation problem and they worsened a housing problem when they stimulated in 2009. So don't expect Chinese authorities to come to the rescue of investors, but don't expect China to deteriorate further, in our opinion. Now, where does Colombia fit into this framework? Well, it's done very well. This is performance over the last year, and the dot is really in the middle there between Turkey and Thailand. So to us, it's neither expensive yet, so we would be looking to hold our positions in Colombia, but keeping an eye on valuations if they continue to outperform. But what I would say is valuations across emerging markets do not look extreme. Let me touch on currencies. We don't think that we can add a lot of value in currencies in the short term, but we do think a lot about currencies in the long term, because we think about earnings growth and equity returns in US dollars or euros. And so we want to be able to convert them. And what this chart shows you is we look at the value of currencies. We assess our own fair value. And so currencies on this side are expensive to us. We look at the real effective exchange rate and adjust it for countries that are outperforming in terms of trade or underperforming. So are their currencies competitive or not? And currencies on this side look cheap to us. We also put in local interest rates, because a currency might be very expensive, as the Brazilian real was a year ago. We thought it was 40% overvalued, but interest rates were 12.5%. So everybody was piling money into the Brazilian real, which is why they introduced these taxes. And what you see is that commodity-linked currencies, which includes the peso here, but in Chile, in Russia, in Indonesia, because of their coal and palm exports, have all become expensive because they have followed commodity prices because of the terms of trade. Relative prices of exports have increased more than relative prices of imports. So we generally worry a bit about valuation of currencies, but most emerging market currencies got hit last year, and that big overvaluation was corrected. On the other hand, a lot of currencies, Korea, Taiwan, China, that are manufacturers that export, they've been keeping their currencies undervalued. But on average, we don't see very extreme levels in currencies as we did last year. Let me wrap up on this section by talking about valuations. I've talked a bit about individual relative country valuations, but this is how we think about emerging markets as a whole. And on the chart on the left, you see a price to book value. So it's the price relative to all of the retained earnings. And it's a very standard measure, as you know. It's very stable. And what we've observed through time is that we only get below 1.5 times book value when there is a crisis. It's happened 6 times. And what we did on the right-hand side is we looked at every month in the last 15 years, if the index was below 1.5 times book value, and you bought and you held for 1 year, what were your forward returns? And this is the 25th and 75th percentile. So you can see that most of the time you had very significant returns. So the message is, when there is a crisis and everybody is worried and book value for the asset class falls below 1.5 times book value, you should be advising your clients to buy, even though that is counterintuitive. On the other side, and this is something that we're not very good at telling people, and maybe it's the same for you, is to tell people when to be selling, to be getting rid of emerging markets. And only on a few occasions have we gone above 2.5 times book value. And you can see on the right-hand side, if you buy at 2.5, you generally lose money. And when you're at that level, everybody will tell you that emerging markets are wonderful, that there's nothing wrong with them. So the message here is that you need to be quite contrarian when it comes to valuation extremes. So let me wrap up there. And we've really touched on three different areas. The first one is, how do global investors view the asset class? Well, they view it as a growth asset, and that fits into the way they think about asset allocation now post the global financial crisis, which is in terms of growth assets and income assets. And that means that we will see continued flows into emerging markets as large pension funds increase their allocation. And that's good news for us generally, we think. But many of them are underweight. And so there could be an element of chasing that benchmark. But also, it's not just about emerging market equities, there's emerging market debt. And that's an important opportunity, particularly on the corporate debt side, for issuance in markets like this. If we go beyond the high level and look at how people access emerging markets, we see a couple of trends. The first one is that most assets are held by global emerging market funds, funds that can own Korea or Colombia or Chile or Russia. And they want liquidity and they want deep markets. So it's important that we continue to see the evolution and deepening of the Bolsa here to make Colombia even more relevant to them. We also see that global investors find it difficult to asset allocate within emerging markets. So this move from regional to global is becoming even more extreme. Not something that we like to see, but that's the reality. We also see opportunities in small cap because they're under-researched, and maybe that's something that particularly people in the audience who have research teams could be looking to develop as a niche for global investors. And then finally, although it doesn't feel like it here after strong performance over the last year, a lot of global investors have been questioning the emerging market story. We can explain it as cost pressures, many of which are cyclical, and therefore we are optimistic on the outlook going into the rest of the year, particularly because we see valuations as very attractive. We also see that the major markets, the BRIC markets, look cheap relative to some of the smaller markets, and if we see evidence of a soft landing, particularly in China, then that will be a large catalyst for emerging markets. So I'm going to stop there. Thank you very much indeed for your attention.